Welcome back, welcome back, welcome back to another episode of Forex Tech Magazine. It's your host, Lewis, and today is February the 12th, 2019. Oh my goodness, going through this year at a pretty rapid pace. 2 days, rather, away from Valentine's Day. If you listen to me, I was about to say 3 days away. Tell I don't got nobody. Uh, if you haven't gotten a gift, if you haven't made enough money to purchase a gift, stick with us today. Hopefully, we're going to give you some tips and tidbits that will allow that to happen. Sorry if my voice is a little up and down today. My ears kind of stopped up, so I can't really tell if I'm talking loud or talking low or what and what. So I'm trying to keep the right pace here so everything sounds normal. But before we get into all that, let's get into this, and that is the disclaimer. And the disclaimer goes a little something like this. Any and all information shared with you by Forex Tech Magazine should be considered to be for educational and entertainment purposes only. Nothing that is shared with you by Forex Tech Magazine should be considered to be investment advice. If you're in need of investment advice, then our suggestion to you would be to seek out the assistance of a licensed, competent advisor. So now we got that out of the way, let's go ahead and get on into it. We'll come back to this one here. That's the Aussie US dollar. Usually that's our last pair of the day that we get in before we close it out. So we'll keep that consistency in place. This right here is the Great Britain pound, the zillion dollar, and it has been trading sideways. Looks like it's trading down inside for a while now. It's right up against that resistance area. Here's your A, here's your B, here's your C. You hit the D, made a new ABC, A, B, it's a new C. Right now it's looking to try to make contact with the D, which is right up here, right? Hasn't done it as of late. As you can see, price needs to cross over this barrier, this basically descending trend line here, right? For us to get into the buy zone, for it to be a move that we want to go ahead and purchase into. Hasn't done it as of yet. Looks like it's closely approaching it. And like I said, right now with this resistance in place, it does seem to be a little hesitation, but something that we can monitor and watch over time. And hopefully we get to it. Dr. P says, greetings and blessings. Right back at you, my friend. Thank you. Thank you so much. Thank you so much. Right back at you. Please let us know if there's a currency pair that you want us to look into tonight, something you want us to check out for you. We gladly do that for you. If not, sit back and enjoy. Hopefully we can not only entertain you, but also give you something from an educational standpoint that will greatly benefit you going forward with your trading journeys. But thanks again for joining us. Let's see here. So right now, looking at this right here, Great Britain pound, New Zealand dollar, still a hold at the moment. It hasn't crossed over into the buying territory. And just to give you a little recap, when we look at using the Fibonacci to trade, all right, especially with the smart trader charting system, right? It makes it real easy. Everything's pretty much color coded. You don't have to go in and just look at the remember the number sequence on the Fibonacci's, right? Everything's pretty much right there for you, right? And all we do is we just look, right? Red to red. So if price pulls back into red, then we're looking for the D extension to be in the red. If price pulls back to the green, we're looking for a D extension to be in the green. And if price pull back to this lavender, purplish, bluish color here, we're looking for price to extend out to this same color here, all right? But we don't look for price to do anything until price gets over into the buy zone. And what I mean by that is, of course, after you have a move up in the market from a price, you're going to get a pullback, right? So those are the buyers that are taking profits. Sellers coming into the market thinking that maybe the price is going to be going down. So you got people coming in to selling, putting in a selling position. Whatever the case may be, you get a pullback in the market. People selling out, or whatever. And once that occurs, right? Of course, you don't want to buy when price is going down, right? You want to only buy when price is moving up, because as the price moves down, can move down all the way to zero, hypothetically, right? And you don't want to do that. But what you do want to do is once price moves down to a significant stopping point and then begins to make its way back up, that's when you want to be buying. And so that's why we put our downward trend line in place to acknowledge that price is moving down, right? And as you see here, price hit this high point, came down, went back up again, touched out that trend line, started to move down, and as you see, you have a sequence of lower highs and lower lows, right? What we want to do is get back in the market when we're buying, when price is making higher highs and higher lows, and it won't start doing that until after it crosses over that downward trend line, right? Once it crosses over that downward trend line, then we know price is starting to make higher highs. Hopefully, it's not just crosses over and then ride the trend line down. You know, we're trying to get some momentum here to ride the price back up. Oh, cool. So for right now, the Great Britain pound New Zealand dollar, that's going to be a hold. But it looks very interesting to potentially start buying. This right here is the Great Britain pound Canadian dollar, and this may be a buy. But let's look at this one for a second. All right, this is a very interesting one right here. If you look at how it's played out. All right, so here goes the ABC. Well, let's go back. First ABC sequence here, right? A, B, all right? Price pulled back to the red. It didn't hit the, did not go into the blue lavender section. And as you can see, price pushed back up, and it did hit the D extension right there. Created a new ABC pattern, A, B, and in that initial moment, this was the C. Price pulled all the way up, pushed all the way up, came within a few pips of hitting the D, and then what happens? Price swings all the way back down, right? So then we put on a couple of downward trend lines, right, to signify when we should be buying to get back into the market. Of course, price crossed over here. That was a buy. But then look what happens when price crossed over, right? Because of this resistance here, in this area here, price crossed over to the buy zone, went up, hit the resistance, and then what? Immediately started U-turning. So remember what we talked about a while ago about support, resistance, and why it's so important to draw your support resistance lines on your charts. Because support resistance lines typically tend to be U-turn points in the market. So these are typically points in the market where the market starts to U-turn, and as you can see, it did here, right? Price pushed back down, and as of late, it looks like price crossed over into the buy zone. And so this is one of those ones where you're gonna have to look at, and you're gonna have to really think about: do I really want to be in this trade? This is a trade that I really think is gonna, be positive for me at the moment, and that's why it is absolutely in your best interest to look at multiple trades, right? Because there's nothing that says you have to be in any one given trade, right? If you're only trading one pair, then you're probably taking some trades that maybe are not the best setups. When I look at this right here, I don't look at this as being the most efficient setup, to be honest with you, because we're looking at how this thing's been traveling down over the last couple of hours here. And now it kind of pops out here. And now we're getting a weak confirmation candlestick for a potential buy. And it just doesn't look strong, especially when we're getting close to the support. Probably more preferable for me would be for price to go ahead and hit the support. Then as it's pushing up off the support, crossing over this downward trend line, making that counter trend line break, then look to potentially buy into this pair. That's where I would be looking at, right around about here, not so much where we're at right now. Not to say this could not be it, but looking at this candlestick formation here, I don't know that it will be. And the other thing is, though, this candlestick formation here has not finished yet, has not completed. It's just 3 a.m. Right now it's like 11 minutes after 3. So by the 4 o'clock hour, I mean, this thing could push up to here or here. Who knows, right? But for right now, this is not really instilling a lot of encouragement in me to want to participate in this particular pair, because I'm looking for something. I'm looking for that momentum. I'm looking for that momentum. I'm looking for that push. I'm looking for buyers to come in. So I'm not the only buyer in here. I'm looking for other buyers to come in here with me, push this thing up. And right now, I'm just not getting the sense that that's happening in this currency pair. So for me, this right here would definitely be a hold at the moment, something we'll be watching. But it's not something that I want to put my money in right now. So let's get out of this one. Let's see. Great Britain pound, Japanese yen. Kind of the same things going on over here. All right. Price has made some. If you look right here, here's the Fibonacci sequence. First one, right? ABC. Hit the D extension here. New ABC. ABC. Hit the D extension here. Create a new ABC. ABC. Right. Here's the D extension. Came close to hitting, connecting with it. Within a few pips away, but then price began to make a downturn. This is where we are right now. Currently, price is moving down and to the side. I remember what I said a while ago. Typically, when price moves in a consolidation, right, which is kind of what you're seeing right now, because price is moving down and to the side, it's kind of consolidating a little bit here. You can see it here. 70% of the time, price moves in the original. Oops, get out of here. Moves in the original direction of the trend before the consolidation started. So, with that being said, there's a probability high probability, and you see this thing is moving down, that this thing may continue to move down a little bit farther. So, very cautious with this one. Be very, very cautious with this one. This right here is the inner trend. This right here is the outer trend. There's something else to not get caught up on. So I've done this before in the past, and actually it cost me a position recently. And something I always, definitely warn folks about is that there's two downward trend lines here. You got the outer trend line and you got the inner trend line. Inner trend line is going to be reflective of the most immediate recent pricing movement, right? And then the outer trend line is going to be reflective of the longer term price movement, right? You can get a pullback during the intermediate price movement, right? And it looks like price is changing direction and is moving up. But really what it could just be is exhaustion from selling or buying. It could be a retracement, essentially. And if you trade just based off of that inner trend line move, then you could potentially be making the wrong trade, right? What you want to do is make sure the overall price movement, right, is being broken. Excuse me. So what I mean by excuse me. So what I mean by that is, if the inner trend line is broken through, that's great, right? There's signals that price is definitely doing something, right? Excuse me. But the real momentum in this market is going to be made once price can move through this outer trend line here, right? Because it's going to take some effort to get through that space. It's going to take some effort to get through that area, right? And price is definitely going to have to be making some higher highs and higher lows to be able to push through that area. So, once again, good to be mindful of the inner trend line that's here. But what we're looking for is a break over that outer trend line before we actually commit to trying to get back into this market. Because what could eventually or essentially happens is that price moves up, hit this outer trend line, and then U-turn, move back down again. And as you see, it's happened already several times, right? Price came up here, didn't quite hit it, but it U-turned when it got close enough to it. Came up here, hit it, definitely U-turn once it got it. So same thing could happen again. What we're looking for is a break above this to signify that, hey, yeah, buyers are in the market, people are running into this pair, and we want to ride that that move up as well, right? And the other thing is too, and I didn't mention this one, but other thing is too, and I mentioned this a while ago, is that you don't necessarily have to trade off of one time frame, right? You see me trading off the hour time frame. I mean, but you can come in and you can look at it on a 2 hour time frame and see if the price is making Fibonacci patterns on the 2 hour time frame. If you can't see a pattern being made on the 1 hour or 3 hour, 4 hour, whatever, you can always go back and check on different time frames to see how price is making these Fibonacci patterns, if there's something to be made in it. But right now, these right here, pretty much in all the different time frames, are still looking like a sale. There's not a consensus to buy. There's no momentum in the market pushing the market up right now. Let's see something. 10 minutes, yeah. Everything's sale. All right, so next one is the Great Britain Pound, IZ dollar. All right. Same thing here. First fib pattern, second fib pattern, A, B, C in the red. Push out to that D extension. But as you can see from the high that it made once the pattern has started to where we at right now, price has been pulling down, hasn't crossed over into the buy zone as of yet. So once again, this would be another one that we'd be looking to hold on to. And just wait till price crosses over into the buy zone before we look to purchase. And then, of course, as long as the price never pulls back below our red Fibonacci retracement here, then we're going to be looking for our red extension, right, to be where we take our profit at with this pair, right? So remember, keep trading as simple as possible. I know a lot of people put a lot of different things on their charts. And sometimes it looks really cool to have a whole lot of stuff going on in your charts. It looks really cool to have multiple charts going on at the same time. But to be honest with you, you don't need any of that. All you need is like maybe one or two proven strategies, something that you understand definitely beyond anything without a shadow of doubt. And they just need good money management strategies, right? Somebody said one time, well, why do you like using Fibonacci's? And I'll show you why right here. The reason why I like using these ABCD pattern is because it helps me put on a complete trade, in my opinion, whenever I trade, because not only do I like something simple, and how simple could it be just looking at colors, right? Red to red, blue to blue, green to green, right? It also helps us with the risk management part, which a lot of people don't fully understand. And that's why you see a lot of accounts get blown up, because people either take too much leverage, right? And they wind up getting a margin call because price starts to pull back, right? And the account can't hold it because, you don't have enough money in the account to keep the account open. So they got to, close that account out. Or when they take a loss, right? The loss is so big that it wipes out the account, or it just kind of knocks them out of the game. And I'll show you what I'm talking about here. So if you look at this right here, you got A, B, and here's our C, right? Typically, what I like to do is I like to put my stop loss under my A, right? Because I understand that for price to pull back below where the original price move started, there has to be a lot of people that's uncomfortable with this overall original move, right? So there must be something going on here where either this thing's about to turn around and it's about to just be a total U-turn, or something happened that came out extremely negative and this thing could push down a lot farther. So that's why I usually like to put my stop loss under my A. Something pretty big had to happen, in my opinion, for price to cross back below the A, right? Now, some people like to put their stop loss up under their swing lows, right? Which is good too, because you've got a swing low. and prices moving higher, right? You're gonna have a low, and then you have a higher low, higher highs, higher lows, so forth and so forth, right? It means momentum is on your side, right? Because the next low shouldn't be higher. I mean, shouldn't be lower than the previous low. If that's the case, now all of a sudden you got a downturn in the market, right? So here you got high, a lower low, a lower high, even lower low, lower high, lower low, lower high. See, these lows are lower than the one preceding it, right? So now you got a downturn. But when you get an upturn, it should be the opposite way, right? And so by putting your stop loss at a swing low during an upturn, then theoretically you should be in a good position, right? But one thing about currency pairs, especially when you're doing the fib pattern, right? You're hopeful, of course, that this right here, that the first swing that you see or the second swing that you see is going to be your swing low, and then you're looking at the fact that you broke over or you broke through, that downturn, right? But the question always remains, right? So we have it right here where we break through this downward trend line, right? Right? Price is moving up, right? Here goes a low, here goes a higher low here, right? Here goes a higher high. This high is higher than this previous high here, right? And so the ideal is that, boom, price is moving up. Here's our swing low, right? But the reality is, with the way the market moves, is that even though this right here was the low at the time when you initially came in, price could still come back and make a lower low, right? Push you out of the trade. So when I look at fibs and I look at making my trade, first thing I'm going to do is I'm going to look at, well, where's my entry? So let's say my entry was here. Let's say I was able to get in, I got real lucky, and got in right here when this candlestick closed, right? The first thing I'm going to do is I'm going to look at, okay, well, how many pips is that from where I going to put my stop loss to where I'm going to enter at? All right, it's 362 pips. That's a ways away, all right? Well, okay, that's a ways away, but where's my take profit going to be? Well, my take profit is going to be at my D extension, right? Because we went red to red, right? Red, go back to the red, so it means we're going to go into the red, right? So let's look at that. So my D extension is 151 pips. So theoretically, if I was going to put on this trade the way that I normally trade, that means that I'm risking 300 and some pips to get 151 pips. Now, you got to ask yourself, is that what I want to be doing? Is that how I want to trade, right? Do I want to risk more than what I can potentially gain, right? And if I'm choosing a standard lot, that's what, 3,000 and some odd dollars that I'm putting at risk to get like 1,500. Is that what I want to be doing? Is that the best way to spend my money, right? Is that the best way to risk my money? And that's why it's so important that you look at multiple, 366. So that's $3,666 that I'd be putting at risk. So that's why it's so important to look at multiple trades before you place a trade to make sure that you're getting a trade that's going to give you the best risk-reward ratio for the money that you're expending. Now, if you're comfortable with putting your stop loss below swing low, right? Let's look at that, how that would work out, right? So now I'm risking 161 pips to get 152 pips. So once again, the question becomes, is it worth me risking, 100? Well, we'll be doing standard lot, $1,600 to get $1,500. Your risk to reward ratio is still off when you think about it, right? Even though it's a little bit still off, because here's the thing: when we're looking at trading, we're looking at long term. We're not looking at short term gratification. We're not trying to just knock it out the park every time. We got to understand that it's a process here, and over the long term, are we going to be prosperous if we stick with that type of risk to reward ratio? And the answer is absolutely not, because Eventually, you know, all it's going to take is a couple of losses, and then your account balance is going to start going down, 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 down. Um, and you know, you're going to have to win a whole lot more than what than what you lost. And there's no guarantee with anything. You know, even though Fibonacci's, I think they work a large percentage of the time. There have been times, and there's actually recently a time where it went below my A, pushed me out. So you got to be careful. One other thing I will say, that if you do decide to trade, um, I believe personally in actively managing the trade. Before I used to be kind of a lazy trader, where I just kind of like just set it and forget it and walk away and go do something, right? Which I still do to a certain extent. But what I mean by being an active trader is that, hey, if you get into this trade, all right, let's look at this trade here again, right? No matter where I put my original stop loss at, whether I put my original stop loss at the A or put my original stop loss here, right, underneath this swing, if I'm getting into this thing, and this is a momentum play, right, because I believe this thing's going up, right, this is where I'm at. We can swing high, we watch it pull back some, it's a swing low, watch it push back up. Now, a couple of things here to do that you can put in place. You could either A, come back and move your stop loss from either here or here, right? And you can push it up to the next swing low, right? Believing that, hey, as long as this thing is making higher highs and higher lows, it shouldn't hit this swing low, and it takes my risk to reward ratio down significantly, right? Because now all of a sudden, instead of risking 3,000 or 366 or 166 pips, now I'm only going to be risking 25 pips, and I'm looking to capture 151, 152 pips. That reward to risk ratio is outstanding, right? Those type things that we want to have, right? So that improves my reward to risk ratio. So that allows me to better make this trade, not only this trade, but other trades as well, over the long term, and stay profitable. Even if I take a loss on this, I can take a loss on a couple of these that's like that and still be in the game, not negatively affect my account. Depending on my account size, though, rather. The other thing is, and this is what I really like to do here, is just put on risk-free trades. Just put on a risk-free trade. In other words, what I'm saying is that once you get a profit, lock that thing in, right? So once again, whether your A is here, whether your stop loss is here or here, right? Once you get over to profitability, right, lock it in, right? And I don't care if that's $1, $2, $3, or whatever the case may be. Lock in your profits, so that way, no matter what happens in the market, price goes back down again. Guess what? You don't take a loss. You don't take that hit. Oh well, sorry, the price went down, but guess what? I got out. I made money, right? Because then what you notice is that at some point, price is going to go back up again. And if price goes back up again, you get back in, you buy, right? As it moves up, you lock in your profit, right? And once it starts going back down again, you're back out, but you made money. So it may require you to trade multiple times throughout a trading period, right? While you're in the process of searching for that D extension, but guess what? You're not taking a loss, right? And your account is growing, it's compounding over time, right? So it's effectively collecting interest on your earnings over time. So I love doing risk-free trades because, like I said before, it guarantees that you're going to make something. The whole ideal, of course, is to be able to make this D extension here. But if you're not able to hit it right off the bat, right? If the momentum that comes into the market doesn't push you up there right off the bat, that's okay, because guess what? You locked in your profit, you made something. And if you're making something every trade, or if you're making something just period, right? You can't go broke for making a profit. Not saying just breaking even and then paying the cost of the spread. What I'm saying is, with spread included and all, that you're making a profit each time, you can't go broke like that, right? But what you can do over time, you can grow that account based off that compound growth that you're getting exponentially over time, right? So anyway, just want to throw it out there to you. So this last one here, which is the Great Britain pound, U.S. dollar. This thing is, man, I would tell you, this thing is ugly, ugly, super ugly. It looks like it's gonna crash back through that A, and once it does, that thing is done. Um, man, oh, this one is wrong. Yeah, I mean, what I just did right there is I used the smart tools to put on a the to use the smart Fibonacci tool, and what happens is it automatically just put all the fibs on this downward progression on the chart for us. So it's already been one, two, and it's in the third pattern right now of this downward fib, and it's showing that the D extension is going to be here, right? Typically, you might see one or two. You might see one. I'm going to say two. Once price hit a peak or whatever, and essentially what it is, it's kind of like a Gartley, showing you where the pullback is going to be at, kind of give you a little extra confirmation. But when you start seeing two and three of these, then you kind of know that, look, there's a high probability that this thing's about to push through your A, you know. Um, so once again, this right here is a hold. Won't buy into this particular pair. And it's crazy though, because you look at it, right? Because here's your A, here's your B, here's your C. The D extension was right out here, and it came so close to hitting it, but just couldn't get it, man. Just couldn't pull it off. Just could not do it for whatever reason. Now, stuck out here in limbo. Mm. Mm-mm. But that's how it happens sometimes. Sometimes it's good, sometimes it's not. So yeah, none of the Great Britain pound pairs. Not excited about any of those at the moment. Not for a buy-in opportunity anyway. I'd be looking to hold and just kind of see what happens. May start looking at this pair as something to sell. I mean, there's a lot of stuff that's going on right now with this whole Brexit, so there's a lot of uncertainty in the market. I'm pretty sure that as we get closer to the big day, there's going to get some definitely some movement in this pair, and we're going to get some more direction. But right now, I'd stay clear of it. Doesn't look like anything that you need to be excited about. Not at the moment, anyway. Definitely something to back off of. Let's check out one more. Let's look back at the Aussie US dollar. Aussie, US. This is the one right here I was telling you about. I got into it earlier this year, man, and it wound up working against me. It didn't work out like I planned. But the reason why was because I was looking at the intermediate trend line, right, and not the overall long-term trend line. And that's what I mean about, going in and having the right thing in place, right? So if you look right here, the overall trend line is what? It's down, right? And a couple things where I could, sit back and I can say, okay, this is where I went wrong with it. First of all, I didn't acknowledge the fact that the overall, well, actually I did, but then I looked at it and I said, okay, well, the overall trend line is overall trend line is going down. I didn't look at that though. But I did look at the fibs and I said, okay, the fibs is going down here, right? And I seen this huge spike down and almost hit that fib. I'm like, okay, this could be something here, right? But then what I did, and this is where a lot of people make mistakes at, and that's why we're looking at this, examining this, to make sure you don't make that same mistake that I made, right? And that we always improve our trading skills, and that we're always trading to, we're always looking to be better traders. Because I went in and I looked at the immediate, downtrend, and I said, wow, this downtrend is broken now, right? Damn, look at this candlestick, man. This thing right here, this candlestick, way down here, huge sell off. Bulls pushed it back up. Second day confirmation pushed it back up. This is definitely a buy, right? And it was a buy all the way up until price hit that downward trend line. And once price hit that downward trend line, price continued that downward trend, right? To sell. And I got to tell you, it's a good lesson to learn, but it can be a hard lesson to learn if if it's costing you your hard-earned cash when you learn it. Right? And this right here is just looking at something we did this morning. So I went in this morning. Price was pulling back. Here's the Fibonacci sequence: A, B. Looking for our C. It's kind of a weird C, but here goes the C right here. Right, a short pullback. Right, going back to the D extension. Right, at the moment we was analyzing this, price is moving back up. Right, it goes a low, higher low, higher low, higher low. We knew that we couldn't get into this thing if we're looking to sell until price broke that trend line that was moving up. Right, we saw that price broke that trend line that was moving up. Went in, took a sell position, started selling, with the anticipation that this would be our price target, our take profit here, right, which is the original D extension. Started to notice though that there's a weakness in the buying. So a couple things that we did is, one, we just put on a risk-free trade, made sure that no matter what happened that we're going to make money off the trade. All right, put that in place, and then what I did is I just drew trend line out, right, just to kind of see what was going on here. And I knew that once price crossed above that trend line, that this whole move right here was kind of going to be kind of dead for a moment, right? And as you can see, price crossed above it, boom, off this nice bullish push, killed the downward momentum, of course. Now price is kind of just moving out sideways, but that's okay. This goes back to prove my point. What I was saying earlier is that instead of staying in the trend or staying in a pair and not making anything off of the pair, right? Because here's the thing: at the end of the day, price is just making its move, right? These are just buyers and sellers in the market, right? So had a good sell-off earlier today. Price pulled back, right? And this pullback could just be in anticipation for the next move down, which is going to be maybe within the next 24 to 48 hits to our take profit, right? So theoretically, here goes the A, here goes the B. I could have put my stop loss here at the C or back at the A or wherever, right? The risk-reward ratio would have definitely been messed up, but could have done it, right? Let price play out over time and then hit its target. Could have done it. Right, but no, what I chose to do is to put a risk-free trade on, so that way I'm trading, I'm guaranteed to make money, right? Because I locked in my profits, right? And if price pull back like it did here, that's okay, because I made my money for the day, right? In this particular case here, it's only a couple of hundred. I think it's like $300 that we made, which is cool. But now what we're going to do is we're going to wait for price to go back down again. And once it goes back down again, you know what? We'll come back in, potentially sell, right? And look to make, some additional cash. The good thing about what we're doing here also is that we use leverage, right? And that's how we make it profitable, because as you notice, there's not a huge room for this thing to run. So in this particular case, we'll use leverage. Maybe we'll use 3 or 4 times the standard lot. So that way, instead of being $10 a pip, it may be 40 or 50 or whatever dollars per pip. But that's okay, because we know that for us to hit our take profit, it's not gonna be a ton, right? So it's about 42, 43 pips, not a ton. a movement that has to take place, but because we use leverage, it's going to make our movement that we do take place more effective. And that's the reason why it's so important to lock in our profits, whatever they may be, so that way, if we do have a move against us, then that leverage that we're using to try to enhance and increase our profit is not going to work against us to enhance and increase our losses. If that makes sense. Hopefully that makes sense to you guys. I'm telling you. Okay. At any rate, I just want to kind of just show you that a little bit, just to show you what we're playing around with today. We'll probably get back in it tomorrow, play around a little bit more. But for right now, we're getting ready to get out of here. I want to thank you guys for tuning in, sticking with us. Hopefully, I was able to show you something. Hopefully, I was able to give you some type of value. And hopefully, you better take something away from this and be able to increase your own profits over the next 24 to 48 hours. All right. So anyway, listen, man, God bless you guys. Take care of yourselves. I will see you back here in another 23 hours. Take care.